Imagine a company worth more than $60 billion that looked unstoppable until the truth came out and almost everything vanished. Thousands of employees lost their jobs, investors lost billions, and one of the world's biggest corporations became a symbol of greed. This is the story of Enron, a business fraud so massive that it changed the way companies are audited forever. At first, Enron looked like the perfect success story. Founded in 1985, it started as an energy company but quickly reinvented itself as an innovative trading business. Wall Street loved it. News outlets praised it. Executives were treated like business geniuses, and its stock price kept climbing. But behind the applause, something very different was happening. Enron's leaders wanted the company to appear more profitable than it really was. Instead of reporting disappointing results, they used complicated accounting techniques to hide debt and inflate profits. They created hundreds of special-purpose entities, separate companies designed to keep massive losses off Enron's official books. Here's the clever part that fooled almost everyone. As long as investors believed Enron was growing, the stock price stayed high. And as long as the stock price stayed high, the illusion could continue. Success wasn't creating the deception anymore. The deception was creating the appearance of success. Why didn't more people question it? Human psychology played a huge role. When everyone around you believes something, it's incredibly difficult to be the person who says, "Something doesn't add up." Investors trusted famous executives. Analysts feared being wrong. Even employees invested their retirement savings because they believed the company they worked for couldn't possibly fail. Then came the twist. In 2001, financial concerns began attracting attention. Investigative reporting and scrutiny from market observers exposed serious accounting irregularities. As confidence disappeared, the entire structure collapsed with shocking speed. Enron filed for bankruptcy, which at the time was the largest corporate bankruptcy in U.S. history. Its longtime audit firm, Arthur Andersen, also collapsed after its role in the scandal destroyed its reputation. The fallout reached far beyond one company. Governments introduced stricter financial reporting rules, including the Sarbanes-Oxley Act in the United States, to improve corporate accountability and protect investors. So what can we learn from one of history's biggest business frauds? First, if a business seems too perfect, ask harder questions. Second, trust evidence more than reputation. Third, short-term gains built on dishonesty almost always lead to long-term disaster. And finally, real success depends on transparency, not appearances. Remember that company worth tens of billions of dollars? It didn't collapse because it ran out of money overnight. It collapsed because trust, once broken, is almost impossible to rebuild. If you found this story fascinating, like the video, subscribe for more incredible true business stories, and let me know in the comments. Which corporate scandal do you think had the biggest impact on the world?